If you have a mortgage renewal coming up, then you want to watch this video. RBC, the Royal Bank of Canada, says that 60% of all outstanding mortgages worth approximately $400 billion are coming due in the next 3 years, and homeowners are in for a payment shock. Hey guys, welcome to another video, and sorry for not uploading last week. I wasn't feeling too well, but I'm 100% charged and ready to go. So I'm just gonna move the screen here a little bit. Take a look at this. Duality shirts. So we've got merch now. We've got merch, we've got shirts, we've got stickers, we've got all of that if you guys want it. I'll share some more details on that a little bit later. So, to recap, 60% of all outstanding mortgages at Canadian chartered banks are coming due in the next 3 years. And that payment shock, yeah, it's going to be a payment shock nonetheless. A payment shock is essentially a payment at renewal, right? And so sometimes it can be good, it can be positive, and sometimes it's not something that you want to hear or see, which is why it's a payment shock. But this payment for homeowners in the next few years is going to be significant. And it's not just the homeowners that are at risk, it's also the banks. The banks are at risk as well, folks. What's worrisome is that people expect to see that their monthly payments are going to increase on average of about 48%. Now, just try to wrap your head around this. That's a big number. The banks are worried, and so should you. Okay, the potential of mortgage defaults are going to be significantly higher, and in fact, Royal Bank's RBC's analysis, I believe his name is Dario Mihelic, states that unless there are significant declines in interest rates, we believe that credit losses will inevitably rise, perhaps significantly in 2025 and beyond. Now, RBC went on to further analyze that $186 billion of mortgages are going to be set to renew in 2024, which is next year. And at today's interest rates, at a weighted average, that is going to be about close to 32%. So when we're talking about payment shock, that's a payment shock right there. I mean, for your payments to go up 32% next year, that's quite significant. That's going to put a lot of people in trouble. In fact, in 2025, RBC says there's going to be approximately $315 billion of mortgages set for renewal, with many being variable mortgages, and the weighted average payment shock for those renewing in 2025 is expected to be about 33%. So now next year, payments should go up about 32%, the year after about 33%. And you know, if you look at the Bank of Canada's overnight rate, which currently sits at about 5%, and the highest it's been since 2001. If the Bank of Canada rate were to drop by 100 base points, okay, which is a percentage, that would technically reduce the payment shock in 2024 and 2025 by about 22%. Well, 22 to 23%. So that's not overly significant, but it's definitely, it would be definitely a step in the right direction, right? Reducing the payment shock for those reviewing in 2026 would require a steeper decline in interest rates. Therefore, homeowners renewing now in 2026 will most likely face the biggest challenge. Okay, 2026 will see the largest proportion of variable rate mortgages up for renewal, which essentially means that unless the rates fall significantly, the payment shock could be as high as 84% on a weighted average basis. So next year, it's expected that rates could potentially jump at about, what do we say here, about 32%. The year after, about maybe 33%. And it's possible in 2026 they could go as high as 84%. That's a bit much, folks. Now, that's definitely worrisome. Lenders are obviously working with their clients to get them to increase their monthly payments now, and to encourage them to make any kind of lump sum payments, extend the length of their loans, or switch them from variable rate mortgages to like fixed term mortgages. This news shouldn't come as a total shock for homeowners. If you want to get an idea as to how much your mortgage payments will be based on a new interest rate or interest rates, you can pretty much, you can simply log online. There's plenty of websites out there. You can even go on your banking website, or you can find like a mortgage calculator. There's lots of free mortgage calculators online. And you can just plug in your data, and based on the interest rates that are projected, you want to be able to calculate and determine where your new payments are potentially going to be. The question is, will this data potentially scare homeowners or new would-be homeowners from potentially owning a home? It's possible. With the rates already as high as they are, and with inflation where it's at, it's not making it any easier for people wanting to get into a home. But there's other news too, that mortgage rates might be coming down a little bit, so it might be cooling a little bit. So it'll be interesting to see how that goes. What else do we got here? The Bank of Canada has been on an aggressive tightening campaign since March of last year, hiking its benchmark rate about 10 times. As it tries to tame persistent inflation. Now, this is going to be important because, this has been an ongoing battle, right? And we don't just hear it here in Canada, in the U.S., Janet Yellen and, Fed Chair Powell. They've been at this game for quite some time, right? And we already know what's going on there, with the interest rates. November 1st, they just met, and the rates didn't change. But they're going to meet again mid-December, and there's a chance and speculation that the rates are going to go up at least a quarter percentage, which is about 25 base points. Yeah. So while the Bank of Canada expects growth to be slower, it also forecasts inflation to be higher than previously expected, which we just discussed. It now expects the consumer price index to be at about 3% in 2024, up from July's forecast of about 2.5%. So the central bank reiterated last week that it's quite concerned that the progress towards a price stability is slow, and inflationary risks have subsequently increased, and is prepared to raise the policy rate further if needed. The bank expects inflation will stay around 3.5% until the middle of 2024, and will not return to its target rate of 2% until 2025. Now, the central bank noted that inflationary risks have certainly increased. Just look at everything that's going on domestically. Actually, look at everything that's going on internationally, right? With all these, global crisis, and with the conflicts happening, Russia, Ukraine, with Israel, Gaza, and with oil prices. Oil prices, that's really interesting. Oil prices are still lower than what they were projected to be. They're down about 12% from last year. And obviously they spiked last year when all these things were happening, and then the price of oil just kind of shot up and went through the roof. And now it seems like oil prices are nowhere near what they were supposed to be, or what people had anticipated them to be, which in a way I guess it's kind of good for consumers, but that could change. And that could change because a Saudi could easily cut back on oil production, and so can Russia, and they're, when they're part of OPEC, anything can happen, right? And so this is This is really interesting, and it's going to be interesting to see how it plays out, because now if things continue to escalate with Israel and Gaza, and if more countries get involved, and it seems like things have started to kind of progress that way, if Hezbollah interferes, gets involved into the war, and Yemen's already, you got the Houthis in Yemen kind of shooting missiles over into Tel Aviv. And more, if this conflict starts to widen, we're gonna see the price of oil soar at levels that we probably never even imagined, and that can be quite scary. So that in itself can turn the whole economy upside down as we know it. The financial experts claim that consumers should not expect interest rates to return to pre-pandemic levels. Now, you remember back in 2019, the Bank of Canada's interest rates were sitting at about 1.75%. Okay? And yeah, we're sitting at about 5%, 5.25%. I don't think those rates are ever going to be, I don't think we're ever going to, you know what? Maybe I don't want to paint the doom and gloom here. Rates should and we're hoping will eventually kind of come down, right? I mean, and it should. You've got all the top financial experts and the brass and all those that are associated with their departments working hard on trying to cool things down so that we can get to some kind of normalcy again. But with all these conflicts happening, so that could also kind of add fuel to the fire. So I think it's going to be a long time before those rates will ever come back to those levels, and there's a strong likelihood that we may never see those levels again. I think as consumers, we need to be better poised to understand the realities of what's to come. And regardless of where you live, it's incumbent upon each and every one of us to do our due diligence and to research and carefully assess what we're hearing, and more importantly, where that information is actually coming from before you go and make any kind of crazy purchases. Look, cash right now is king. Cash will always be king. Okay? But it's also important to make sure that you have your money working for you, right? And any investor or would-be investor should understand that, look, you have to get your money to work for you. And unfortunately, with all the calamities and issues happening all around the world, people are still going to find a way to profit like they've never profited before. And that's just the unfortunate reality when it comes to investing. You've got like all these weapons companies like Raytheon and North Grumman, all these companies coming out of the woodworks. They're making hand over fist profits, right? And so I'm not just saying you have to invest into those kind of markets, but there's going to be a lot of deals in the real estate market. And it seems like commercial interest is kind of back, commercial real estate is on an upswing again as well too. So do your due diligence, do your research. I think I stress that in almost all of my videos, and be very, very careful to ensure that you have all the facts in front of you before you make that decision, because this will not only just affect you, it's most likely going to affect your family. And people are wary, man. People are very, very wary. So see kind of what's going on out there before you do anything. And if you walk into that, and understand that if you try to buy a house right now, the interest rates are high. If you try to go buy that new car that you've been wanting for so long, interest rates are high. It's not that they're going to be high. They're already high. They're at the highest that they've ever been. So does it really make sense to buy that new car right now? Sure. You have a great relationship. You went in and the salesperson was super nice to you and they treated you to a nice little coffee or cup of cappuccino or hot chocolate. And the salesperson advises you not to be concerned. Why? Because with the current high interest rates, which they'll obviously tell you, hey guy, look, you know what? You want to buy this new car? It's a beautiful car, isn't it? But I agree with you. Interest rates are absolutely ridiculous. But maybe if you buy this car now, chances are interest rates are going to come down. And when they come down, you can refinance, get a better rate, and then everything is going to be good to go. And yes, that's partially true. But the question is, when are these interest rates going to come down? We don't know, right? We don't know when these interest rates are going to come down, if they're going to come down, right? If you walk into that dealership and the salesperson's encouraging you to go ahead and make that purchase with confidence, knowing that the interest rates are going to go down, and that you can refinance at a lower rate in the future, it's definitely worth doing your research and reconsidering when making that purchase decision. While it's possible that interest rates could decrease slightly, expecting an immediate change is likely overly optimistic. On the other hand, if you believe that interest rates will return to pre-pandemic levels, it's definitely prudent to exercise caution and careful planning in your financial decisions regardless. So many borrowers are opting for shorter mortgage terms in response to these considerations that we just discussed. So interesting to see. All right, in other news. So while we're on the topic of these issues with in the mortgage industry and what's to come, get this. The Toronto Star, which is a huge publication in Toronto, Canada, reported that many homeowners in the GTA, which is the Greater Toronto Area, are finding themselves in a very, very difficult position. And why is that? Why are they reporting this? Well, because these individuals are unable to qualify on their mortgages, forcing them, many of them, to walk away from their deposits. Some of which are upwards of around $300,000+. Now, just wrap your head around this. Imagine you put a deposit down of about $300,000 for this new house or condo or whatever real estate that you're purchasing, only to find out after that you're unable to qualify for the mortgage, and pretty much leaving you with very little option other than to walk away from that monies. I can't even fathom this. As closing dates near, appraisals are falling short, making it difficult for buyers to qualify for a mortgage. So as these closing dates are coming to a close, coming closer to the end of the completion, appraisals are happening, and appraisals are not appraising these property values to where they're supposed to be, making it very difficult, creating a shortfall, a difference between what it's appraised at and what the mortgage is at. And because these individuals are not able to qualify for a mortgage, they're kind of screwed, right? So they're finding it difficult to offload their assignments, which is when the original buyer transfers the rights and obligations of the purchaser agreement to another buyer, which in most cases results in about a 2% penalty, by the way. This is happening. This is happening a lot, and unfortunately, and so when I talk about assignments, and an assignment could be, so for instance, if you were to purchase a condo, there's a lot of new developments happening, right? And you really want to get into this building, and maybe you're dealing with the realtor, or maybe you're dealing directly with the builder, and you purchase a unit in this building, right? And say right now it's 2023, and they're saying, well, the completion is not till 2025. And you're like, great. And they're like, listen, in order for us to complete this paperwork and to fulfill this assignment to you, you just have to give us this percentage down, which could be anywhere from 5, 10, 15, 20% down. So you're like, okay. And the good thing is, you don't have to qualify for the mortgage until you get closer to the time of completion. And it's at that time the real work begins, right? And the appraisals have to go in, and have to make sure that the property values are where they're supposed to be, and then you have to qualify for a mortgage. And if you don't qualify for a mortgage, well, you're pretty much on the hook for completing that assignment. Now we'll talk about what happens if you're unable to fulfill your obligations or fulfill your end or your obligations as part of the contract. Now, during that time you own that assignment or you hold that assignment technically, right? Because you technically don't really own it until it's, the mortgage has gone through and you're fully qualified for that property. But you are allowed in some cases, depending on the builder, not with all developers, but you might be able to offload your assignment to, say, a friend, a family member, or somebody else for that matter, for whatever the price may be, whatever you discuss with them. But while you do that, you would have to notify the builder, the developer, of what's going on, and usually that would result in a 2% penalty fee. So in some cases, I've heard of people offloading their assignments and adding that 2% contingency to their purchase agreements and whatever. And then it would be the onus on the individual purchasing your home to be able to qualify for that mortgage. However, and you got to be very careful with these contracts, because if the person the person who's taking, or group of whoever it is that's taking it over from you, this assignment, they have to qualify. If they don't qualify, there's a chance that you actually may still be on the hook. So you can't just go and offload an assignment without letting anybody know. There's a lot of paperwork that needs to be filled out. The builders and all of them, they all get involved. And anyhow, there's a long process in that. I've heard of a lot of people getting burnt by not properly doing the right thing. So again, buyer beware, caveat emptor, right? Like you have to make sure that you're always doing your due diligence. Now, we talked about home prices are starting to soften a little bit. Mortgage rates, the possibility of mortgage rates kind of coming down a little bit. It's still quite difficult for a lot of people, even with the softening of the market, to qualify for a mortgage, especially when they need to qualify at around 9% interest. Now, why so high? Now, if the rates are at about like 6% or as upwards of like between, or let's just say the rates could be anywhere from 5 to 6, 7%. Well, a lot of banks, right? A lot of the chartered banks, they have these stress tests, right? And these stress tests are there to add a couple percentage points to whatever interest rate you're getting, because they want to see if you're actually able to qualify at a higher rate, because that gives them the confidence in knowing that you should be financially okay to be able to weather any kind of short-term, in-term financial craziness, right? Like turbulence, I guess is the word that I'm looking for in the economy. So if you qualified at an interest rate at about 5%, technically you need to qualify at about 7%. And again, the banks will just feel a little bit more reassured knowing that in the event that something crazy happens, inflation goes out of control, interest rates go up, you should be capable of being able to handle those payments. Because at the end of the day, the institution that's loaning this money, all they care about is getting their money. That's all they care about. If you pass away or something happens, that mortgage payment doesn't stop. It continues. So it's very important to make sure that you're dotting your I's, crossing your T's, going through each line in these contracts and understanding what you're reading. And if you don't understand, then you need to ask questions. You need to consult somebody. So it takes an average of anywhere from 6 months to a year for a detached or semi-detached home to be built, which is the reason why we're seeing so many people walking away from their deposits, now realizing the difficulties of qualifying for their mortgage. So if you purchased a home in 2021, 2022, and say the construction is set to complete sometime in 2025, 2026, then you still have time. Okay, you still have time to try to get your financial affairs in order and to be in a position to ensure that you're ready and able to qualify for that mortgage. Deposits, as I mentioned, typically can range anywhere from like 10, 15, 20%. Usually they're in the 20% region. That is normally paid out to the developer as soon as they break ground. Okay. Now, if the buyer, and I'm going to get to this now because I was talking about what happens in the event that things go south. For the purchaser, they're unable to qualify. Well, if the buyer is unable to close on their property at the time of completion, then the builder technically has a right to seize the property for significantly less than what the original buyer paid for it. And the builder can still go after the original buyer for the difference in cost. Wow. Some areas in Toronto have seen home prices fall by 40%, with homes that were originally appraised at $3.2 million now closer to the $2 million range. Now, homes that are located 1 to 2 hours outside of the Greater Toronto area, outside of the Toronto area that were once appraised at $1 million are now anywhere around the $600,000 mark. Now, if the house was valued at $1 million and now there's a new appraisal at $600,000, you just lost 40% of that home value. Incredible. And meanwhile, while this is happening in Canada and the US, mortgage rates have ticked down this week. The mortgage rates actually, and it's interesting that I'm saying this because over the last 7 weeks, the mortgage rates have just been kind of going up and up and up and up. But this past week, mortgage rates have kind of gone down a little bit. So the 30-year fixed rate mortgage in the U.S. fell to an average of 7.76% in the week ending on November 2nd. Down from 7.79. So, went down by like 0.03%. And this is according to sources from Freddie Mac. So a year ago, the 30-year fixed rate was at about 6.95%. Right? So, yeah. And, the Federal Reserve, we're talking about interest rates, right? I mean, their benchmark, their lending rate, it's still at its highest that it's ever been over the last 22 years. It's absolutely crazy. There's so much to talk about in on this topic, and I'll continue to update you guys. I think this is important, right? Because there's a lot of people who watch this that are homeowners, and if you're not a homeowner, you're thinking of getting into a home, these things are important. It's really important to understand the numbers part of your purchase, and this is where you have to understand that sometimes the numbers might significantly impact on your emotion or your ability to purchase a home, which is why you have to, as hard as it's as easy as it sounds to say this, if I say, well, just take your emotion out of it and go ahead and purchase that home, it's not that easy. Okay, everybody, whenever you're purchasing a home, unless you buy and flip homes for a living and you do this like 5-10 times a quarter or whatever, for you it's like whatever. But for the average person getting into their home, and in most cases could eventually be your forever home, there's obviously going to be emotion tied into your purchase, right? But when it comes to the numbers, you really have to make sense of what the numbers are telling you. And at times, some of those contracts could be very difficult to understand. So it's very, very, very important, right, to understand what you're getting into and the pros and cons and the ramifications in the event things don't go your way before you make that purchase. And I can't stress that enough. As long as it takes you for you to find that place, it should take you just as long to be able to understand the financial part of your purchase needs. There's so much also going on in the world of finance. You probably heard about, but we don't have time for this, but former FTX CEO Sam Bankman-Fried was found guilty on all 7 accounts of fraud and conspiracy to commit fraud. And this just happened, but we don't have enough time to talk about this. We'll talk about it another time. But you know what? I appreciate you guys joining us. Thank you. And I will talk a little bit more about this merch. And if you guys want to get hands on one of these shirts, maybe a ball cap or a mug or something to show your appreciation to the channel, I'll definitely put some information. Information will be coming out shortly on that, of course. And in the meantime, please like and subscribe and share. That will definitely help with the YouTube algorithm. Thank you guys, and we'll catch you on the next one.